In this week's market update, safe havens are in favour as North Korea raises the stakes again. All eyes are on the ECB as the end of QE looms, and classic cars top the list of so-called passion assets. Investors are not yet running for the hills as tensions in the Far East ratchet higher, but they are certainly looking to hedge their bets. So-called safe haven assets are back in favour after North Korea tested what appears to be a significantly more powerful nuclear weapon, and the US said that all options, including unthinkable ones, remain on the table. Gold hit an 11-month high, up 0.9% yesterday to $1,337 an ounce. That's a level it last reached in the aftermath of the US presidential election in November, when markets looked for a port in the storm while they assessed the arrival of Donald Trump in the White House. Meanwhile, the Swiss franc, a reliable store of value in troubled times, rose 0.5% against the dollar, and the Japanese yen was 0.7% up at fewer than 110 yen to the greenback. By contrast, most stock markets are in modest retreat as investors consider their attitude to equity risk. Unsurprisingly, Asia set the tone after Sunday's massive test triggered a literal and metaphorical earthquake in the region. South Korea's Kospi index fell by 2% at one stage, although it recovered somewhat later in the session. The South Korean currency, the won, was also down more than 1%, and the country's bond yields rose slightly. The war of words between Pyongyang and Washington took a worrying turn over the weekend as Defense Secretary Jim Mattis came out of a meeting with Donald Trump and top military advisors to warn that any threat to the US or its allies in the region would be met with a massive military response. That was followed by the US's ambassador to the UN, Nikki Haley, commenting that North Korea appeared to be begging for war. The Defense Department now believes that North Korea may have the ability to hit the US West Coast with nuclear weapons, which clearly raises the stakes significantly in the long-running standoff between the two countries. Although geopolitical risk has intensified over the summer, this has not prevented stock markets around the world continuing to edge higher. Investors are still taking the view that a robust economic recovery feeding through to a positive second quarter earnings season is more important for now than any sabre rattling in North Korea. The global measure of stock market strength, the FTSE All-World Index, completed a 10th successive month of gains last Thursday, driven by good news from both the US and China. Second quarter GDP data in America was better than expected, while China's Manufacturing Purchasing Managers Index defied expectations of a dip. The Chinese measure has now been above the 50 level, which separates growth from contraction for 13 months on the trot. And that's led to a sharp rally in some commodities, including copper, which has risen by 20% since the end of May. At $6,900 a tonne, it's already $1,000 a tonne higher than analysts had expected it to end the year. The American growth data made up for a slightly underwhelming jobs figure on Friday, which showed just 156,000 jobs were created in August, often a rather weak month for employment. The jobless rate also ticked up slightly from 4.3% to 4.4%, and wage growth was below forecast. As is often the case, however, investors preferred the Goldilocks reading of the data. Not too weak to threaten a real slowdown, not so strong that the Fed feels obliged to accelerate its pedestrian rate of monetary tightening. Markets have been driven again by a resurgence of support for technology stocks, which pushed the tech-heavy Nasdaq index to a new record high on the last day of August. Investors are increasingly succumbing to FOMO, or fear of missing out, as no one wants to be left out of the remarkable performance of the so-called FANG stocks, Facebook, Amazon, Apple, Netflix, and Google owner Alphabet. Next week is expected to see the launch of the next generation iPhone 8. History suggests that Apple shares tend to do well in the weeks following a new launch, and talk is turning to whether Apple will become the first trillion-dollar stock on Wall Street. This week, the attention swings back to Europe, with the ECB due to unveil its latest thinking on interest rates and quantitative easing on Thursday. ECB President Mario Draghi disappointed some observers at the recent Jackson Hole meeting of central bankers when he gave nothing away about the timing or pace of Europe's tightening path. Analysts think that the strengthening in the euro in recent weeks may have taken some of the pressure off Draghi because, all other things being equal, it will tend to bear down on inflation in the region. The situation in Europe is the exact reverse of the UK, where a falling pound has tended to push inflation higher. As a result, the consensus view is that Draghi will suggest that the end of QE remains some way off, with no specific end date in the frame. Interest rates will almost certainly stay marginally negative. Recovery in the European economy has been a major driver of fund flows so far this year, but more recently, that strengthening in the euro has taken the shine off the region for investors, because it makes life more difficult for Europe's exporters. Fund managers pulled $1.4 billion out of European equity funds in the week to August the 30th, according to data provider EPFR. That was the largest redemption since March, when investors were worried about the outcome of the French election and the outside possibility that Marine Le Pen would be handed the keys to the Élysée Palace. Attention is now focused on the equally important German elections, which take place in 3 weeks' time. This time, however, there seems little doubt about the outcome. Angela Merkel's Christian Democrats and their coalition partner, the Christian Social Union, are polling 38% to the opposition Social Democrats' 24%. Meanwhile, on this side of the channel, the government's repeal bill, the main piece of Brexit legislation, is set to be debated this week in an increasingly acrimonious atmosphere in Westminster. The repeal bill is designed to transplant most EU law into British law, providing continuity after Brexit and allowing any changes to be made thereafter. So, getting the bill through Parliament is fundamental to the success of Brexit, and the government is keen to silence any naysayers who wield significant power with such a wafer-thin majority in Parliament. Theresa May's attempt to rally Conservative MPs raised hackles, however, when she suggested that any dissent would increase the threat of a Jeremy Corbyn-led Labour government. So, Brexit continues to arouse passions among MPs. For investors, though, it's not always as high on the agenda as other so-called passion assets. These are things like wine, fine art, coins and classic cars, items which people invest in both for enjoyment and potential profit. And they're measured by the Coutts Objects of Desire Index, which the private bank calculates has risen by 77% since 2005, compared with a gain of just 52% for the FTSE 100 over the same period. Classic cars underperformed last year. They fell in value by 10.4% in 2016, but they have risen by 330% in the 12 years that Coutts has been tracking these desirable investments. Trophy properties, those valued at more than £10 million, also fell in value in 2016 by 7.5% in London, but they continue to soar in value elsewhere. Prices rose by 20% in New York, 5% in Paris, 6% in Shanghai. Over the long haul, however, Mumbai is the standout performer, up 200% since 2005. Market timers in this niche set of asset classes will have focused their attention on musical instruments. They rose by 16% last year, the best performing passion asset in 2016. But this is a volatile investment. They fell in value by 11% the previous year.